Good evening and welcome to the FITT Show, financial information for today and tomorrow. I'm Bobby P. Kinzer,
And I'm Thomas Doty.
and we are the FITT Show, helping out people to get their finances in shape. Welcome out there around the United States and the world, especially in Great Britain and from our friends in Holland and Amsterdam and Australia that be tuning in. Hello, everybody, and welcome. This show, we try to provide you with information that you can use, information that can make a difference in your life, your kids' life, and your friends. So, Dote, how are you doing this wonderful day, sir?
Doing fantastic.
As always, with you, I got to ask, where in the world are you?
At Pompano Beach in Florida with the grandkids.
Whoa, how's the weather down there? How's the sun?
It was good until today. We got a little rain today, but it's been nice. It hasn't been too hot, which is good.
Oh, okay, that's a good thing. Well,
yeah, nobody's here either.
Oh, wow.
Everybody's back in school. My grandkids don't start
that's
back
right.
until after Labor Day.
School has started in a lot of places, man.
Not for Jersey. Not till after Labor Day.
Until Labor Day? Wow.
After Labor Day, yeah.
After Labor Day, yeah. There's still a few schools that go by that. But I'd like to welcome everybody. And like I said, this is the FITT Show. And before we go any further, just a couple of administrative things. Just want to let y'all know, you need to click on the like button, and that helps us get traction, exposure to more people. That's how it works in Facebook. And those people who are on YouTube, hit the subscribe. Thank you. Getting old though. Hit the subscribe button, and that helps us on YouTube too. But on Facebook, not only click on the like button and the heart button, but also if you have a comment, put it in the comment box. If you have an opinion on anything we saying or a question, put it in the comment box. Or if you have an idea or some things you want us to talk about and discuss, if it's in line with what we're talking about today, we'll take a minute and talk about it. And if it's not, we'll talk about it on another show where it's more applicable, okay? So just keep that in mind. We like to make this interactive, and that's how we make it interactive, by using the comment button. And by the way, the more things you put in the comment box, it exponentially exposes to more people than just the like button. So we really like if you have comments, so please put that in the comment box. Dope, man, what's going on in the world today, man? We've got the convention, we got wars, we got the stock market. So what good news do you have for us to tell us about the stock market?
Well, no good news, but no bad news. I think we won't know anything definitive until after the Fed meeting and we get an indication of what they are going to do with interest rates. I think it's pretty much a foregone conclusion that rates are going to go down. The big question is how much.
Right.
The market was on track to have its best week of 2024 until today, when we hit some headwinds. And it's mostly just nervousness about what the Fed's going to do. If you look, you can see that really not much happened. The market had pretty much come back from that August 5th drop where everybody had the recession fears and we had a big drop. And the market had come back pretty strong until today. You can see the week-to-week S&P is pretty flat. Same with NASDAQ. But take Microsoft, for example. Microsoft was up to about 424 today, and it ended up dropping about 8-9 points. Just nervousness in the market, trying to gauge what's going to happen with the Fed Reserve meeting that's coming up this week. And they're hoping to get some indication as to how much the rate cut's going to be. Tesla's down slightly. Apple's pretty much flat. So is Pfizer. Nvidia's pretty much flat. Nvidia had gotten up to about 130. Google picked up a couple. Again, it's fallen off a little bit. But I think once we get through Friday, we'll have a little better indication of what's going to happen in the market. there's a if there's a half a point cut, I think things will be fine. If it's only a quarter of a point, I think there may be some negative reaction to that because people are expecting a bigger cut. So we'll see how that goes. And as we always tell you, just hang tight and play the long game.
Hey, Doc, can you just give a clarification for these people who look at this chart today and go, wait a minute, the NASDAQ's up 24 points, 28 points, but this is a week-to-week comparison.
Oh, correct. Yeah, and this week has had, again, we were on track to have the best week in 2024. It was going to be a good week until today when the NASDAQ kind of took it on the chin. It dropped about 300 points. So we would have seen some slight increases had we not had the turmoil today. So again, that's just nervousness about what's going to happen in this meeting. I think that's all that is. So hopefully the Fed will do what they should do. Rates will come down a half a point and things will be a little positive, but it's hard to say. It's
Right.
hard to say.
But as you can look at this chart, though, you look over week, you shouldn't have done that bad. You might have hurt today, but look week over week, you're still ahead. So that's
Yeah,
one.
but it was up a lot more, Bob. It was up. Yeah, the market was rolling this week. Had a pretty good week until today.
Right, exactly. That's what's so interesting. And we're going to talk a little bit about that today, about pullbacks and things like that when we think this, usually when the market drop, it's been a consecutive bull market, and then it drops and they think it's going to a bear market. Like Dote said, sometimes it's just the market adjusting itself. People are just making a little bit different decisions to do with their money, but it doesn't necessarily mean we're going into a bear market or we're going into a recession. So keep that in mind, you all. But we like to look at these numbers because it's good. They're good indicators, so you can see how things ebb and flow, and you'll see that our strategy, not just our strategy, but our comments about how the long term benefits you better if you're doing the short term investing.
Yeah, so, and Bob, I think what we ought to do maybe is show a comparison to a year ago, just to see how much. Maybe we'll do that next week. Show a comparison to
time. Yes.
Same time last year. Yeah, just to see how much it's changed.
Yeah. So let's talk about the cryptocurrency market, though. Now, this is once again week over week, right? And today, the Bitcoin was down a bit, but this is week over week. It was 5% up by $2,786 per Bitcoin. Total market was up 5% too. So it's interesting. Remember, we were talking about trying to see if there was a correlation just by us, the way we're looking at this. Was there a correlation when the market go down, did cryptocurrency go up? No. Remember last week, though, when the market went down, cryptocurrency went down. But this time, the market went down and cryptocurrency sort of stayed up. But Ethereum, the smart contract, now that was up 20%. Wow. And the Elon Musk dog coin, or actually pronounced Dogecoin, it's still just rolling along at 10 cents. So if you've been in this cryptocurrency market since 2010 and 15, you should be still happy. But if you got in around 2020, you might not be as happy. But that's how it goes in the cryptocurrency market. Interesting, though, there's a lot more new cryptocurrencies out there too. That's what's so incredible. They keep making new cryptocurrencies. It's over like something like it's some weird number like 40,000, but it's only 9,000 that are actually active. That's crazy, but that's the cryptocurrency market. So, Dope, let's talk a little bit about today's subject. Last week our subject was talking about breach. If your data had been stolen and it was breached, what to do about it. This week we want to talk about investing mistakes to avoid, and there's a lot, but we just want to talk about a few that we think can help you.
Yeah, and we're going to talk about some, and the big thing is to learn from what we talk about, and hopefully you won't make these mistakes in the future. If anybody looks back, they'll see things they should have done differently, woulda, shoulda, coulda. That's always big in the market, and hopefully you haven't made a lot of mistakes. But we're going to mention some things that you shouldn't do, and if you found out you've made some of the mistakes, not to worry, because you can always recover from those. And investing is lifelong. So it doesn't matter that you make a mistake. You start from today and you build on from whatever point you currently sit. You don't worry about what's happened before because there's nothing you can do about it. Lifelong, you want to continue to build wealth from where you are. Everybody's going to make mistakes. I don't think you'll find anybody who hasn't made any mistakes. Most important is to learn from those mistakes. And it's really funny because I may get this wrong, but what is it? I think a dumb person makes the same mistakes twice. A smart person learns from other people's mistakes, and a brilliant person never makes mistakes. So hopefully you're at least a smart person and don't make a lot of mistakes. Okay.
You scare me, man. You're starting to sound like George W. Bush. Fool me once and fool you twice.
No,
I wanted to ask you to repeat that, but I ain't gonna do you like that.
No, it's pretty good because important thing is learn from your mistakes and learn from other people's mistakes. That's the important part. Yeah.
And though this is the interesting thing about mistakes, right? Because a lot of people worry about doing, making the wrong decisions, right? But the good thing, the positive thing about making wrong decisions, you usually find out how to make the right decision because you made the wrong decision. So sometimes, like you said, you learn from your mistakes. Don't get all emotional anxieties because, like you said, though, nobody's perfect. Either these big time hedge fund people, man, they don't know. They're just trying to predict with the best data they have, you all. And a lot of times, it's just by lady luck, to be honest, and just hope that you can use the law of probability to your advantage. And that's why we talk about diversifying. But though, check this out. This comment. Modestine says a bar of gold is selling for $1 million. Modestine, where are you shopping at these days? A bar of gold?
That's true.
That's awesome.
But she's absolutely right.
But check this out, though. They made it illegal for regular people to buy bars of gold in America now. They can't do that anymore. That's why it's interesting. I saw that they selling.
I thought that's what Costco was selling. I thought Costco was selling bars of gold.
Not the bars like she's talking about, like the $1 million, like really gold bullion bars. Okay. They don't sell them, but Costco is just taking these little things, calling them bars, melting them down. But no, actually bars because of really gold, like the big chunk of gold, they made it illegal to sell that. But I don't know. Maybe Modestine is on to something that we don't know about. Maybe they open it up to selling a gold bar.
No, it's just the value, but it is $1 million. I saw that also. She's right on it.
So tell me this though. Who would buy a gold bar? What do you think a reason to buy a gold bar would be? You have any knowledge?
I mean, what? Why not?
Well, it's like what I believe. I think you should hold some of your gold so you don't have to worry about the market and all of that. And if it crashes, you go out. So it might not be a bad idea if you got a bunch of money and get yourself. But I ain't gonna lie though. I always wanted to have a gold bullion bar of gold, but I didn't know it was $1 million. Good Lord. Okay. but though, I just want to talk a little bit, comment a little bit about this avoiding mistakes, like and many people out there struggling with their money and avoiding common investment mistakes during economic challenges. It can have a big impact on your financial health. I mean, it's easy to get emotional about money. We talk about that all the time, and it affects your behavior, your biases. Being overconfident, lost aversion, we talked about that, or even jumping on the bandwagon, resisting the urge to jump on the bandwagon because your friend told you, investment they had, how it jumped off, and you think you might have missed it. Now, this can push investors into making decisions that undermine their efforts to reach their goals. And we always talk about having financial goals, having a plan, right? Now, this might be especially true today in the market with recent memories of the pandemic, high inflation, simultaneous stock and bond market collapses, and recession fears. These events have left a strong imprint on investors, attitudes and about their behaviors. And the effects are not always positive, but staying mindful of these mistakes today that we're going to talk about, just a few, just might be make you better equipped to overcome some of these mistakes that, common people make.
Yeah, I'll get going with the first one, Bob. And that's worrying that every market stumble is the start of a crash. And that's people with basically a negative outlook on things. And a lot of times you end up making poor decisions because you think, oh, the market's about to crash. But sudden pullbacks, they happen all the time. If you're nervous about the stock market in general, and you get one of these little pullbacks, you can panic, and again, make some really, really dumb decisions. I shouldn't say dumb decisions. You can make decisions that aren't in your best interest. We've had big pullbacks this year already in April, July, and we just had one in August, 5th of August, when there was a fears of recession. And everybody thought each of those was the start of some serious downturn. But in fact, there wasn't. They're routine. They happen in the stock market. And we've told you before, when we show you the graph of how the market has grown, the market doesn't go up in a straight line, okay? It's overall, it tends to go up, but there's always corrections, there's always pullbacks, and they're very common. It's analogous to a mountain climber taking a break to refresh, catch his breath, regroup, get himself together again, and then he continues to move forward. That's pretty much what the market does. So these pauses or temporary declines, they could signal that the market is processing new information. It's got more information. Investors could be recalibrating. They could be taking gains. There's a lot of reasons for these setbacks and nothing that you can control or do anything about. But they're not always bearish signs. Sometimes it's just the market is readjusting, getting more in balance, and then it'll continue to move forward. That's happened in history, and it's going to continue to happen in the future. You just have to be accepting of the fact that there are going to be some downturns in the market.
Now, this next one, though, I've been a victim of it. Avoiding the stock market because it's gone up. Now, that's the other way, where the stock market's gone up and you think you missed it. I did that with gold. I saw gold at 300, then it went to 600. I'm like, oh, I missed out. Then it went to 900. Oh, I missed out. Then it went to 1,000. I said, I'm getting in. I ain't going to keep doing this stuff. But even after, like you talk about the recent pullback, United States stocks have had a strong year so far, given the series of all the new all-time highs we've had, all-time highs. It's made in the past few months many investors be wondering if it's time to get out or not get in. And sometimes, we get those fears because it went up. We think we've missed the boat. But after seeing the stock market rise quite a bit, many investors start to wonder whether or not they may continue. Hearing that the market has made all-time highs may even make some investors nervous enough that they'll avoid investing more money or even cash in some of the winners. It makes them apprehensive because they think, oh, here comes the bear market, I'm owed my money. But part of the concern may stem from misunderstanding about the history of the market. And that's what me and Dope tried to provide information about it. And like we say, Past performances are no indicator of no guarantee, of future returns, but still they're indicators. So when investors in analysis describe past market cycles, they often note that the market made new all-time highs before declining, and the all-time highs marking the end of a bull market, and it's going to start immediately go down. But this can lead to a misconception that any all-time high is perceived by what me and Dope were talking about today, a pullback, the market going down. Now, if you look back historically, Dope, the market making all-time high is very common occurrence. Bull markets have often spanned multi-year periods, multi-years, like in 2000, from 2000, like 8, 9, 10, 11, 12. I mean, it consistently was a bull market. They kept talking about, oh, it's going to be a recession. It's going to be, collapse. Now, the market has made all-time highs after all of this. Now, investors who took every all-time high as a signal would have missed out as a signal that the market was going to start going down, missed out on some substantial gains. So it's not true that whenever the market has made an all-time high, a correction has come around the corner. More often, history shows the market has continued to rise.
Okay, and the next one, it's really important not to make this mistake. And that's focusing too much on a narrow group of stocks or looking at what's really hot and then jumping into that small, narrow group of stocks, or even a mutual fund, buying one that's been hot lately. And if we look at the recent bull market, we've talked about how the market has been strongly influenced by the tech sector, the Magnificent Seven, and a lot of people jumped on the bandwagon and started getting in there and maybe putting too much money into those stocks because they were riding so high and going so well. And that can be a recipe for disaster, because at some point there's going to be a correction there. And I've said this before, and it bears repeating. If you're looking for this get rich quick advice, that's not what we're about. We're about systematic, consistent investing, growing continually, and having a well-diversified portfolio instead of looking for trying to hit the home run. It's nice when you do. It's nice when you do get a winner. But if you're well-diversified, you're going to continually move up. If one segment's doing poor, the other segment might be doing well. You don't want to get hung up in and have too much of your eggs in one basket, where you end up kicking yourself because you're at risk too much in that one particular market. And that can end up really having a bad effect on your overall money. So sticking to a small group of stocks, not the way to do it. You want to be diversified. You want to be in different sectors. You want to be in different regions. You don't want to be concentrated in one area, even when that area is hot. You don't want to buy the latest mutual fund that did the best last year and put too much emphasis into one segment, one stock, one sector. You want to be diversified, and so you have a consistent growth pattern. And that gets into trying to guess what's going to be the next best thing, the next big thing. And I'm sure there are people that can do that. It's never worked for me. I have been lucky on hitting some, and NVIDIA was one that I bought a long time ago. That did really well. Microsoft, Amazon, all those have done really well for me. But again, that's not the bulk of my money. That's a small part of what I have invested. And so you don't want to be overly concentrated into anything. You want to be well diversified. That way you can handle the downturns. You can handle when one segment gets some bad news, you have another segment that's doing okay. And it tends to keep your growth more level, more steady, and your risk is spread out amongst various different investments.
Hey, no mistake that investors make is holding too much money in CDs and short-term investments. Now, short-term CDs and treasuries have come in favor, especially in the last 2 years, because the rates have risen for them, because the market was going down. So, interest rates for, CDs and short-term investments like treasuries, they were up, even though, they wasn't giving you a return the stock market was, but they were giving you consistent and they were less risk that they would default. And they had predictable cash flows. So people were going with that. But there are many wonderful features of short-term investments, although there are many, but investors with long-term outlook, as me and Dote always talk about, historically often be better off. It makes you better off in stocks. Now, the key challenge with short-term investments is the lack of stronger growth potential, right? While it's true that stocks may be more volatile than short-term investments or bonds in the near term, over the long run, stocks have provided much higher returns. Although the rates on these investments may appear attractive, right, on these CDs and high yield savings accounts, they may not be providing much growth after accounting for inflation. For instance, if you're getting, 4%, on a CD, and inflation is at 3%, you really are only you're netting 1%. Moreover, rates potentially poised to fall if or when, like Doe was talking the other day, when the Federal Reserve starts cutting those rates, staying in short-term positions can leave investors exposed to reinvestment risk. What I mean by reinvestment risk is if you're in those positions and they go and lower the rates, then you locked into a CD, and now you're missing out because your reinvestment rate you're at risk because you can't reinvest because you got your money locked up. So investors who have time on this side can typically benefit from having a broader exposure to stocks and bonds, like we said, being diversified, a combination of the two, as opposed to staying in just short terms for a long time.
Okay, next thing we're going to talk about is not looking at taxes in your investment decisions. And be clear about this. We're not talking about tax decisions driving your investments. We're talking about minimizing taxes and understanding that that's part of the equation. And a lot of times you look at your brokerage account and say, I can buy and sell, but brokerage accounts, they're not tax deferred. And so end of the year, you got to make sure you deal with Uncle Sam. And there are decisions that you can make throughout the year that can lead to possible lower taxes. For example, we've talked about the short term versus long term. If you hold an asset for longer than a year and sell it, you get favorable capital gains treatment versus selling something within a 1 year time period, and then it counts as ordinary income. And we also talked previously about when you have separate accounts, you have an account that's tax deferred versus an account that you have to pay taxes on. You might want to do all your all your risky or growth potential things in your tax deferred account because you won't have to pay capital gains taxes on those transactions. And maybe in your brokerage account, you might be a little more conservative, or a little more tax efficient, and making sure you don't have a lot of tax generating income in those accounts. Let me make sure you're clear with what I'm saying. For example, if you have an IRA account and you have your brokerage account, okay, your brokerage account is what you buy and sell your daily, and you pay taxes on those transactions. But we always talk about understanding your risk. And let's say we always talk about how I'm about 7 out of 10. Bob's about 5 out of 10. So that means I'm 70% aggressive and 30% conservative. So in a perfect world, I'd have my conservative money invested in something that I would have to pay taxes on, because the returns on those should be lower than the 70% that I'm more aggressive on, where I'm looking for gains, looking for growth stocks. And so if I, in a perfect world, I would have those monies invested in something tax deferred, where I don't have to worry about the tax consequences of those transactions versus in my brokerage account. So you have to look at your whole portfolio. And if you can, you want to make sure you have your conservative stuff is where you're paying your taxes. Your aggressive growth potential stuff ideally would be in a tax deferred account. So you have to take that into account, the decisions to be made that can affect your taxes. We would never tell you to avoid paying taxes. You just want to minimize what you pay and make sure your investments are tax efficient.
No, that was very well explained, though. But I gotta tell you something, though. It was funny, you were talking like this, with your hands. Normally, we don't see that because you're doing a fuller picture. And I don't know if you saw President Obama speak, and he talked about
Crown
Donald Trump
size.
smalls. That's what you mind me. You kept doing this, and I'm just dying laughing. So don't pay no mind to me. I got a warped mind, the stuff that I think about.
You do.
Oh, thank you. I'm glad you. So anyway, Doug, I want to talk about analysis from paralysis. That could be a problem for many investors. What I mean by that? That's
Said it
like
backwards.
no analysis of paralysis. That's it. You can say it either one. Paralysis
yeah.
works either way.
Okay.
But it's letting the perfect be the enemy of the good, meaning even if you come up with a solid investment plan, it can be easy to get caught up in the, well, wait a minute, what if questions? What if I did get out? Or what if I do get in? Or what if I do what the Joneses did? What if I'm missing out on even better investment options? What if the market crashes tomorrow? What if my plan just doesn't work out? That's I know some people that does do that overthinking, man. And the reality is that investing is inherently uncertain. I don't care if you're the greatest financial fund manager there is. Even the most experienced investors can only work with estimates, not certainties. So while investors might worry about the right answer to any given investing question, like what investment to buy or when to get into the market, the fact is there may be a range of reasonable solutions. But I guarantee you this one thing has been true time and time again historically. Over long periods, and we've said this, and it may sound like we riding a horse down the valley and back up the other side. But over long periods, investors have done better by being in the market than being out of the market. If you got a well-rounded, suitable plan that's sensitive to your financial needs, not anybody else's, then don't let hangups about the perfect investment or the perfect time derail you or distract you from your financial goals. It's important, you all.
And Bob, let me piggyback on what you just said, and that's the last one we're going to talk about. And it's focusing too much on news headlines and politics, and we like to call that the noise. You're focusing on the noise. You develop a sound plan, okay? As far as a diversified portfolio, you figure out how much you're going to save, where you're going to invest, what your risk level is. You get a solid portfolio, and things are going to come up. And Bob mentioned so eloquently that there are things that happen. There's people say things, as news comes up, you get people with their opinions on things. And we talked about it at the beginning of this show about market pullbacks. All those things are going to happen. You have to have your nose to the grindstone. Once you set up your portfolio, it's diversified. And we're not saying stick to it and never change, but you have to ignore the noise. You have to understand what's noise and what's real. That's obvious. You can't assume everything is noise, but you have to know the difference between noise and it's time to make a change in my investment portfolio, whether or not I need to sell something I own because it's no longer the value that I thought it was when I bought it. It's no longer it's no longer a good company or a good mutual fund or a good stock. There are times you make changes, but in your fundamental plan, as far as what your risk tolerance is, where you plan to invest, those things really shouldn't change that much. And there's not much that can happen that should cause you to change those. Okay. A lot of people are saying, okay, there's an election coming and I need to make adjustments because of who's going to end up as president. Those are kind of things that you have to ignore. They don't make a difference. You're investing for the long term. The market's going to digest all the information and continue to go as it goes. Okay, there's going to be things that happen that are going to cause the market to go backwards, but that shouldn't affect your fundamental investment portfolio if it's built the right way. And when I say that, you may need to share it with somebody and say, hey, does this make sense? This is where I'm putting my money. These are the sectors I'm getting into. These are the stocks I'm interested in. These are the mutual funds. Bounce it off somebody, be it a friend, be it a financial advisor, be it someone who shares a similar investment philosophy as you. But once you set that up, there's got to be something fundamental, a big change in order for you to change that, to change your outlook on how you're invested. And so when we talk about ignore the noise, there's going to be a lot of things that come up, a lot of things that happen. You kind of have to ignore those things that aren't fundamental changes in your investment portfolio and just focus on what you're doing, think long term, continue to put money away. We always tell you, forget about trying to time the market. Like one of the items we mentioned was people thinking the market's oversold. Oh, it's too high right now. I'm going to wait until it backs up before I get in. And it doesn't work. Timing the market does not work. There's people who work at this full time and they still can't time the market because so much of it is uncertain. The best time to invest is right now and continue to invest over the long term. We've showed you hundreds of times how the market has done over the long term. Don't try to time it. Set your fundamental plan up and let it ride. That's our advice.
And Doe, and I submit this to you all. Don't get into these. Don't let politics be driving your decisions. Whether it's from a Democrat, whether it's from a Republican, independent, we get into these. Oh, they caused it. Oh, this is no. It's not. It's your money. If you manage your money properly, it doesn't matter if a Democrat is in. It doesn't matter if it's a Republican. It doesn't matter if it's a tsunami. It doesn't matter if it's a pandemic. You may take a hit, but it will, if you will be cushioned against a financial shock. And that's why we stress having a plan, and some people want to hear, we got to do it. They want us to do one on budgeting. We need to really do that because that's also, what's that? A spending plan. So just want to put that out there, though. We know a lot of people want to get to watching the rest of the convention to see Kalama come on the AKEA Ski Weir. But let's go to the video, Dope. Let's go to the takeaways. And I'll start it off, Dope.
Okay.
Let me start it off. Let's get this party started, right? The first one is we talked about this thing called pullbacks, right? And pullbacks of when the market go down or when it crash and you think it's crashing, but it could be it's just pulling back and adjusting itself. They are normal. It doesn't mean that the market's getting ready to crash. It doesn't mean that we get ready to go into a bear market necessarily. It's just they have these ways of adjusting itself. You know, sometimes it's a period where people are taking their profits, and that's what's making the market go down. It could be a million things, you all, but don't let pullbacks deter you from either staying with your investments or, like me and Doe say, if they do pull back and go down, hey, maybe that's the time to get in and get in on the lower cost of the stocks. Or if you don't have the money to get in, just stay where you are. But don't panic and jump out because you think the sky's falling.
Number two is invest now. The best time to invest is now. Don't have money sitting in a checking account, savings account, making 0.1, 0.2% interest. Find a conservative stock fund to invest in, and don't try to time the market. Don't try to wait until the market takes a hit. Money sitting in a checking account is going backwards for you. It's not earning you any money. The best time to invest is right now, all day, every day. Right now. Don't wait.
And don't let the market fool you when it go up and you think you missed it. That's not necessarily the case. Diversify. We say this all the time. We can't say it enough. Diversify, diversify, diversify. And what we talked about today, because there's many different explanations on diversifying. And today we talking about diversify as being don't be concentrated into a narrow amount of stocks. You know, don't be just concentrated in all environmental stocks. Don't be concentrated in all utility stocks. Don't be concentrated in all growth stocks. Don't be concentrated in just stocks. Get some bonds. So don't be just so concentrated that your investments are narrow, and when one thing happens, it affects them all in the same direction. That's what diversification is about.
And finally, avoid the noise. Be focused on what you're trying to do. Develop a good plan, a good budget, good goals, a good risk level, and avoid the noise. Focus on what you're doing. Know you have a sound plan. Know it can withstand pullbacks, and move forward. And Bob, before you sign off, we forgot to do the Experian thing, to freeze your credit limit. We'll do that next week.
So let me ask you something. Did you just read that?
Read what?
What you just said. We forgot to ask about, because the reason why I say that, because Modestine just sent us this. We supposed to discuss freezing your credit. So Modestine,
I didn't see that.
He don't see I see the comments. He don't see the comments. And so you on time. Go ahead. but Modestine wanted to know about how to freeze your credit and what's the difference between locking and freezing.
Yeah, we'll do it next week. You have the app, right, Bob?
Say it again.
You have the app, right? The Experian app.
Yes, I do.
And you could just share your screen and we can walk through it next week. We'll do that.
Right. Actually, it's not the app. I got the app. Right. I do.
Yeah. I'm sure you do.
Yeah, I do have that.
We'll do that to start next week.
Yeah, and Modestine, I know you said y'all said that last week. And look, here comes Noli. Yes, let's do it next week. Because Noli want to see Kamala. I feel you know. So look, shout out. Gotta let y'all know Modestine down there in Lexington. Noli and my sister Linda, my sister Gloria. Y'all are the best sisters in the world. Rodney Madison, the noteexperience.com. Go out there and check them out for an alternative investment option, you all. And now What's up now? I hope you enjoying those grandkids and you enjoying Florida. And oh, Kitty Cheney, the queen of Toastmasters. What's happening, Kitty? Pamela Hill, University of the District of Columbia's finest adult, one of the best social workers in the Washington DMV area. Thank you all for tuning in. I think I got it. Oh, Motor C said I won't be on next week. I'll be in Cancun. Aren't you the lucky one? So you're just going to have to get us directly, and we're going to have to tell you, but we're going to let people know. Thank you all, but it will not be complete unless Bob gives his quote of the week. Notice how I'm rhyming, though? So,
Pretty good.
This is for the young people out there. This one this week. This is for the young people. Oh, Pam says she's gonna be a family union. There's a lot of y'all rolling. Y'all almost making some money. So this is for the young people out there who think they could just start coming at a job and be a director and want the highest paid money. Think they can stop at the top. This quote is for them though. The only job that you start on top is if you're a grave digger. With that, like what, Doug? You didn't like that, Doug? With that, have a wonderful week, y'all. We'll see y'all who's going to be here next week. Be here or be square. Remember back in the day, don't be no L7. We see y'all next week. Peace and have a great week, you all.